Hello, this is 2.7 World Markets, and we'll be going over what is deadweight loss, common misconceptions, examples, and consumer surplus and producer surplus, and tariffs. Okay, so what is deadweight loss? Deadweight loss is lost efficiency when markets don't reach equilibrium. It's the value of trades that could have happened but didn't. They're like fewer sales after tax. There's a common misconception that when it comes to world markets, people think that world markets equal price ceiling, and that is just not true. So the world trade sets a new market price based on the supply and demand, not the tax on itself. So it's not a price ceiling, it's just a new trading price. So what would happen if the world price was lower than the equilibrium? If the world price was lower than the local price, the domestic price drops. And the consumers will buy more and the producers will sell less. And basically, the country imports the difference. So when consumer surplus rises, the producer surplus will fall. So let's look at import and surplus changes. At a lower world price, the equation for imports would be quantity demand minus quantity supply. And the consumer surplus will go up, but the producer surplus will go down. But the total surplus will go up because a trade adds efficiency. Now let's look at the effect the tariffs have on the market. A tariff will raise the price and it will cut imports. It will lower consumer surplus and it will raise the producer surplus and it will give tax revenue. But it will also create a deadweight loss from the lost trades. So what happens if the world price is higher than the equilibrium? When the world price is higher than the local price, the domestic excuse me, the domestic producers export the extra consumer surplus and producer surplus, and the total surplus from the trade gains.